Okay, thank you very much for that, Rodney. I think we have a little more detail from Marian George on the investment front, Marian is one of the external independent advisors to the fund in terms of its investments. So, Marian, over to you.
Okay, thank you, Councillor Thornton, and thank you, Rodney. So I will briefly cover quite a lot of ground in terms of the investments of the fund. So what I'm going to talk about is I'm going to do a very quick summary of what happened in the investment markets for the financial year ending March 2022. I'll look at the evolution of the fund value and the asset allocation. I'll make a few comments about short and long-term performance of the fund, some observations about why that performance has happened and what we're planning with future asset allocation. And then I will look at what the investment panel are going to be focusing on in the coming year. So on the next slide, I think it seems a long time ago now, considering what's just been happening in the markets the last few weeks. But from the year from March 2021 to March 2022, global economies continued to recover quite strongly post the lockdowns that we saw from COVID-19. However, labour shortages, particularly in the UK, in the hospitality sector and transport, together with disrupted supply chains from COVID, such things as cars, microchips, etc., and higher energy and fuel costs, started to see inflation rise towards the end of the year. And the Bank of England initially felt that that was temporary and that that would soon abate, but it became quite clear that it was a little more than temporary. So in December 2021, the Bank of England raised rates for the first time in about 5 years. We went up from the extraordinarily low rate of 0.1 to 0.2%. And they were followed by the central banks in the following months, such as the US Federal Reserve. As Rodney has already alluded to, or actually I think it was Councillor Thornton, the year ended with Russia invading Ukraine in March 2022, which meant that there was a setback of all markets at that point. So we did, unfortunately, at the end of March, or lost some of the ground that we'd had, but we still had positive returns. I'll come on to those in a moment. And because of that invasion, we saw oil and gas prices increase significantly, which I'm sure you're fully aware of, as well as commodities such as wheat, sunflower oil, fertilizers, etc., that were major exports from Ukraine. So at the end of the financial year, equity markets performed well initially, but as I said, lost some ground towards the end of the year. Bonds, on the other hand, or fixed income, which is government debt, struggled on fears that inflation was more than temporary. So on the next slide, I've briefly summarised what the returns for the 12 months to the end of March were. So starting on the left-hand side, you can see that government bonds had a negative return over that period, as did the debt from UK corporates. However, index-linked bonds had positive returns as inflation came to the fore. But those returns you can see in the middle there are equity returns, and those were all positive, and we'll see later they were key drivers of the performance of the fund over the year. And on the right hand side, you're showing the property return, which again was also positive, along with other alternative investments such as private equity and infrastructure. So how did the fund evolve over the year? And so on the next slide, you can see at the end of 2021, or March 2021, the fund had a value of just over £16 billion. There was some investment of additional money into the fund, but the key driver of the return on the market value was nearly an extra 1.6 billion from the investment portfolio, which meant that the fund at the end of the year had a value of over 17.8 billion at that point. So where did most of that come from? As you've seen on the previous chart, it was mainly from equities, but also in this chart it actually puts. I've got confused and should be looking at allocations. So how did the allocations over the year change? You can see here that we had a planned strategy to decrease exposure to equities, which we did over the year. That fell, and we increased our exposure to alternatives. Property and fixed income stayed broadly the same. So just returning to what I was saying earlier, so the key impact in terms of market movements over the year, as you can see here, the big drivers of performance came from our exposure to UK and overseas equities, where over £750 million was added to the portfolio from that, and also from our private equity holdings. Again, over 400 million there, which is significant returns. So on the next page, looking at a little bit more detail of the returns, you can see here, and Rodney's also gave you some of these numbers earlier, that for the year to the end of March 2022, the fund had a return of nearly 10% against its benchmark of 8.2%. The fund has a fund-specific benchmark which reflects the liabilities of the fund and also the risk appetite of the fund, and that's very specific to the fund, and I'm pleased to say we did outperform. It's also sometimes interesting to look at how the rest of the local government pension scheme universe performed, and you can see there that they had a return of 8.6% last year, and so the West Yorkshire Pension Fund not only beat its benchmark, but it also beat the other local authorities. So just looking at the long-term performance for a moment, as I've said, it's really important to look at your benchmark, which is set in such a way to exceed the assumptions in the liabilities, which are that assumption is approximately a return of 4.25%. So you can see here over the long term, and let me just explain this graph for you. So the yellow bars are the Yorkshire Pension Fund, the blue bars are the custom benchmark, and the green bars represent outperformance. So you can see over the long term, the fund has outperformed its scheme specific benchmark. And you can also see the blue bars are all greater than 4.25%, which is approximately the return assumed in the liability calculation. As Rodney mentioned earlier, it's also important to think about inflation. The liabilities of the fund are linked to inflation. That's not only the salaries of people within the scheme, but it's their deferred benefits for those who are still active, and for pensioners, it's their pensions. So that's what I've done on this chart. So again, the yellow bars are the fund, but this time the blue bars are CPI inflation, which is the government's preferred measure of inflation. That stands for the Consumer Price Index. And again, you can see here that over the long term, over the last 20 years, that the fund has beaten inflation on all periods shown. So I'll just make some observations about that long-term performance and also the asset allocation that has led to that. So on the next page, I'm going to talk about the performance of the fund versus other local authorities. I think it's very important to say that the previous page is the really important one. That was about the performance versus CPI, but also the performance versus the benchmark, which is scheme specific and has been chosen specifically for West Yorkshire to make sure that it achieves its long-term objectives within an appropriate risk tolerance. But it's interesting to look at other local authorities, and sometimes you can learn things from those about best practice and what they may be doing, and maybe get some pointers about where we might be headed as well. So on this page, again, yellow is the West Yorkshire Fund and blue is the local authority average. And you can see that this year the fund did really well and it beat the local authority average, but on previous years, or sorry, over longer periods, it's underperformed slightly. So the real question about that is why. And I'm actually going to skip the next page because it doesn't look quite as easy to read as I'd hoped on the big screen. So we'll just move on to the equity page. That's it. Thank you very much. So the key question is why. So here I show the equity performance of the fund versus the other local authorities. And on the left-hand side are the last 5 years, and on the right-hand side are the longer periods. And you can see that really it's the equity performance here that's driving the returns, and that the fund has underperformed, in terms of its allocation to equities. And again, the question is why. So if we turn on to the next page, I'll give an indication of why that is, and then also talk about what we're going to be doing about that. So here I have shown on the left-hand side the asset allocation of the fund, compared with on the right-hand side the local authority average. So on the left-hand side, you can see that UK equities at 28% for West Yorkshire and overseas equities at 37% account for, at the end of March 2022, 65% of the allocation, and the alternatives in yellow were at 15%. And that split between UK and overseas is approximately 45% UK, 45% overseas. Whereas the local authority average, you can see they have about 10% in UK equities and about 42% in overseas equities. Again, and that split there is about 20% UK, 80% overseas, and they have more than West Yorkshire alternatives. And those are fundamentally the reasons why that long-term performance has dragged a little, because over the last 5 to 10 years, overseas equities have performed very well, and our bias to UK equities has held us back. Although equity performance generally has been good, it hasn't been as good as some of the alternatives, where again we've been underweight. So what have we been doing in that? So those of you who were here last year and remember the presentation from last year will remember that my colleague Mark talked about our long-term target. We did, following the last actuarial valuation, we did a review of investment strategy and agreed that over time we would reduce the equity weighting. So here in the middle column, I've shown that we're planning to go to 55% in equities, and we're going to use that reduction in equities to fund an increase in fixed income and alternatives. And we're well on our way to doing that. And in fact, one of the things I'll talk about in a moment about plans for next year will be we're reviewing strategy again. Before I move on to looking forward to what's happened since March, I just wanted to mention a couple of other, I think, important achievements that the team and the committee have achieved. So since last year, they've revised the ESG policy. We've become a signatory to the UK Stewardship Code, which is an extremely hard code to agree or become a signatory to, and that's all about the good governance of the fund. So I think well done to the fund and the team for achieving that. And the fund has also produced its first report along the line, what's called TCFD, which is the Task Force for Climate-Related Financial Disclosures. So that's all about the carbon emissions and things like that, which are in the fund, and that's on the website for anyone who wants to read it. So that was a quick summary of what happened for the financial year to end of March. But I'm sure you're all aware, you'll have been reading the papers and watching the news. A lot's happened since March to now. So the next few slides, I'm going to give you a brief overview of what's been happening. So this first chart is CPI, and you can see that in the late 90s, inflation was quite high, but it's fallen quite dramatically since. And for the last sort of 10 years or so, it's been relatively low. It's been volatile, but quite low. However, since sort of 2021, it started to rise. Initially, the Bank of England hoped that was temporary, but because of things like increase in energy prices from Ukraine, it has increased dramatically. And actually, at the end of September, as Rodney mentioned earlier, the inflation rate was 10.1%, which is the highest it's been for over 40 years. And now inflation is not just from gas and energy prices and fuel prices, it's actually widespread. So we're seeing high levels of inflation in food and clothing and travel and quite all services. So it's very widespread across the economy. So what has that caused? On the next page, sorry, these charts are very small, but the top left-hand one, you can see here that this is the dark blue line is the Bank of England's base rate. As I mentioned earlier, it had been very low coming into the end of last year, but slowly over the last year or so, the Bank of England has continued to raise rates at each of its meetings, and now the bank rate is at 2.25%, and we expect that to continue to rise and there to be another increase at the November meeting. And the pale blue line there is the US Federal Reserve, their interest rate. And you can see again that that rate has increased. And not only is that rate now caught up with us, but it's overtaken us because their recent rate rises have been much bigger. So short-term interest rates have risen. And again, I'm sure you'll be aware of that because of your own mortgage payments. And what's been happening the last few weeks is we've also seen on the right-hand side here, this is the interest rate that the government has to pay on their long-term debt. And on the left-hand side of that chart, you can see that at the beginning of the year, the government was having to pay about 1.25% on its long-term debt, and that has risen substantially over the year, and particularly in the last few weeks. And that, I'm sure you'll be aware, has been driven by the change in government and at the time, the Chancellor of the Exchequer, Kwasi Kwarteng, and his mini budget where he announced 45 billion of unfunded tax cuts. That was not taken very well by the markets, and so they pushed up the long-term government borrowing because they couldn't see how the government were going to pay for that except have to borrow more. That, as you're aware, has caused quite a few problems in the private sector pension market, but not the public sector market. So I just want to reiterate Rodney's point that your pensions are safe. We've had a change in government, and that long-term rate of borrowing for the government has started to fall, which is really important. However, it does mean that that long-term rate affects corporate profitability and government borrowing. So on the next page, I've shown you what's happened in the equity markets. So on the left-hand side is the UK equity market, and on the right-hand side, global equities. These charts are from the beginning of the calendar year, but you can see that actually UK equities have fallen since the end of March, and so have global equities. And that has been driven by an increased cost of borrowing, both in the UK and globally, and the market's fears about what's going to happen in terms of corporate profitability, but also the fact that the Bank of England have stated they believe the UK will be in recession towards the end of this year and beginning of next year, and it looks like there'll be a recession in the other major economies, such as the US as well. The consequence has been on the next page that we've seen a fall in the market value of assets. So at the end of September, the fund had a market value of just over 17 billion. However, that is still more than at the end of March 2021. So a few final thoughts. So next year, what will the investment panel be focusing on? We'll continue to look at our reduction in equities and how best to do that. As Rodney's already mentioned, there'll be an actuarial valuation, or there has been an actuarial valuation, and the results will be available soon. And following that, we'll look at our strategy again. The fund is focusing on recruiting staff. We'll continue to enhance our responsible investment policies and our reporting, and again, continue to enhance our governance procedures. And from a tactical perspective, we'll be looking at the economic risks, including inflation and slower growth, and looking to identify opportunities both in the public market, but also in alternatives. So thank you for listening.